Ever wondered what a compounding machine is? A compounding machine is a concept and not an object. The concept is simple. A compounding machine is an investment that grows at such a high rate that an investor holding it becomes wealthy, extremely wealthy in fact. You must be wondering how wealthy and how fast. Again, the answer can differ based on whom you ask. But I think a simple explanation suffices. 100 times your capital in a generation, commonly defined as 25 years. This is an extraordinary investment result, a result only great investors can dream of. In this video, we uncover the 3 secret ingredients to build such a compounding machine. When these 3 ingredients are used in conjunction to analyze stocks, they are immediately able to separate the compounding machines from the ordinary businesses that surround them. Let us start with the first ingredient, the return on equity. Return on equity is the most important metric used by super investors to find stocks. Why is this ratio more important than the more popular PE ratio, you wonder? Would you like? It is important to understand that the PE ratio is a valuation multiple. Valuation multiples, while important, are not as important as ratios that measure the quality of companies. In fact, judging the quality of a business is one of the most important tasks for an investor who wants to find multi-bagger stocks. Hi, this is Prashant Saraf and you are on my channel Blueprint Investments. I am on a mission to arm 1 lakh investors with the knowledge, strategies, skills and tools to create life-changing wealth for themselves and their family. Quantitative measures to judge the quality of a business. However, there is one quantitative metric that incorporates almost all of these factors within itself. That metric is a return on equity. What is return on equity, you ask? Well, in simple terms, it is the profit percentage that a business makes on the invested capital. Coming back to the video, let's take an easy example for understanding. So presume that you set up a food outlet in a mall. Now, if your initial investment in the business is 1 crore and it generates 20 lakhs profit for you in the first year, then your return on equity is 20% or 20 lakhs divided by 1 crore. This return on equity should be higher than the cost of capital if the company is to create any value for its shareholders. As the cost of capital for most companies in India is at least 8%, we can set a minimum benchmark of 1.5 times or 12% as the minimum return on equity for companies in India. Next, you may well wonder, why is this metric so important? Well, consider what Charlie Munger told Warren Buffett in the 90s, who till then used to buy average quality businesses at a discount. Charlie Munger is said to have remarked that in the long run, a stock is likely to yield the investor returns in line with the return on equity. Warren Buffett, on realizing the truth of this statement, completely switched his investment philosophy to buying high-quality companies with moats like Coca-Cola. Now that we have understood the background, let us take a step back and understand this ratio. Return on equity is considered an important, if not the most important metric to judge stocks because it measures a company's efficiency in generating profits from the capital it has employed. A high ROE indicates that a company is effectively utilizing its capital and generating high profits, making it a potentially attractive investment opportunity. So return on equity can be understood with the formula net profit divided by owner's capital. So net profit is quite easy to understand. It is the profit available to the company's shareholders after all the expenses have been accounted for. To understand owner's equity, however, we need to see the balance sheet of the company. The balance sheet of any company has 3 basic heads, which are debt, what money is owed to others, assets, what assets are owned by the company, and owner's equity, which is nothing but the difference between the two. Another way to look at this is to say that the assets of a company can be bought by one of 2 methods, either by taking on debt or by the owner's own funds. To understand this better, we can look at the balance sheet of a company, Gravita India, which is a metal recycler in India. So the assets of Gravita India for the financial year ending 2022 stood at 997 crores, while the liabilities stood at 597 crores. The difference between the two gives us an owner's equity figure of 400 crores, while the net income of Gravita India for 2022 financial year stood at 139 crores. So the return on equity of Gravita India for 2022 was 139 crores divided by 400 crores, or roughly 35%. Now we can immediately see that this is an example of a high quality company, as its return on capital is way above 12%. Return on equity can be also compared to the cost of capital, providing insight into whether a company is generating adequate returns for its investors. Warren Buffett had this to say about return on equity. Return on equity is one of the most important measures of a company's success. Warren Buffett's mentor, Benjamin Graham, had this to say: the formula ROE is simple and well known, but its value is often overlooked. Having understood return on equity and its importance, let us go a bit deeper and see if we can break down the formula and forge a deeper understanding. To understand more clearly from where the company is making its returns, we can break this formula into three components. So visually, we have net profit upon sales multiplied by sales into total assets, also called asset turnover ratio, multiplied by total assets upon equity capital, also called as financial leverage, is equal to the net profit upon equity capital or return on equity. This concludes our video showing how return on equity is one of the most important parameters to judge the quality of companies. We will reveal the other two ingredients that create a compounding machine in the following video.